Welcome to the Deep Dive. We're here to cut through the noise and get you straight to the insights that matter. Today, we're tackling a pretty big idea. What if the real engine behind human progress, behind the prosperity we often see, isn't really about politics or economics? What if it's something, well, more fundamental, something tied directly to physics?
It's definitely a perspective that makes you stop and think.
Yeah.
And it's the core argument in the Macro Butler's latest weekly newsletter, From Watts to Wealth, the true engine of prosperity. And they make some pretty bold claims in there, sometimes quite controversial ones, too.
Oh, absolutely. So our mission today is to really unpack those core arguments for you. We'll explore how energy fundamentally shapes our wealth, our freedoms, and maybe most importantly for many of you, the investment landscape. Think of this as your shortcut to getting up to speed on a topic that honestly often flies under the radar. It's especially useful if you're navigating the financial world looking for that edge.
Right. And just so we're clear, everything we're discussing comes from our analysis of that newsletter and its sources. We're here to lay out their argument, give you their perspective on these, well, critical dynamics.
Okay, let's jump in. They start with what they call the sunderous clarity. The idea is that modern prosperity, our freedoms, they didn't just emerge from political theories. No, they argue it was forged by dense, high-quality thermodynamic power. It shifts the whole conversation from politics to, well, physics.
It really does. And they immediately bring up the laws of thermodynamics. The first law, energy isn't created or destroyed.
Yeah.
Simple enough. But it's the second law that's crucial to their whole thesis. The idea that the quality of energy, its ability to do useful work, always degrades. Entropy. And this concept of transformity, basically, how useful and efficient energy is, they say that's absolutely central. It determines if a society thrives or just stagnates.
Right. Transformity. If you really get that, it changes how you look at energy policy. It's not just about ideals. It's about hard physics. The core idea they present is fascinating. Wealth, at its core, is just ordered energy doing our chores. Think about before the Industrial Revolution. What did people rely on? Wood, muscle power, and, as the newsletter puts it quite vividly, a prayer.
Societies were generally poor, rigid, power was tied to land, and then coal happened.
Yeah, and this is where the story really takes off, according to the newsletter. They point to coal in Britain in the 1700s, ancient sunlight compressed into black gold, as they call it. This wasn't just another fuel source. It ignited the Industrial Revolution. It powered factories, railroads. It completely reshaped society. Suddenly, there was real upward mobility. Literacy spread beyond just the elite. A total transformation, all thanks to this incredibly dense energy. Okay, so fast forward to today. The Macro Butler argues that, controversially, we're now ditching these high-quality sources, natural gas, nuclear, even clean coal, for what they call weak and moody wind and solar. They claim these are so unreliable your phone battery looks dependable in comparison, and the consequences they foresee: less energy overall, higher costs, shrinking freedoms, and even a comeback tour for the landlord class. Strong words.
It's definitely a provocative take,
Right.
and it makes you question how we measure progress, like a GDP. The newsletter says all the glorious GDP everyone brags about is just energy refined, transported, burned, and turned into spreadsheets and Tesla. They make a really important point. It takes energy to get energy. Drilling, transport, refining, all that. If the energy you get out doesn't pull its own energetic weight in terms of real utility, they argue basically just destroying capital. Even your MacBook, they say, needs to justify its existence in energy terms. If it doesn't create more utility than the energy used to make and run it, it's just an expensive paperweight.
And they back this up with some pretty striking data on primary energy production. In the U.S., they say primary energy use has been flat for 25 years. Europe and Britain, falling steadily since the early 2000s, which they directly link to what they term dramatic deindustrialization. Britain's numbers are stark. Primary energy consumption down a massive 34.4% since 2005. And globally, growth in primary energy consumption slowed way down to just 1.29% annually over the last decade, while real GDP only trawled up by 2.79%. It paints a concerning picture.
Looking at the bigger picture, the newsletter is very clear about government's role. They argue its only legitimate role is protecting against corruption, not central planning. Their view is that when capital gets diverted by bureaucrats or politicians, it just drains the system, destroys capital, and shrinks GDP. They cite examples like a 1% rise in taxes relative to GDP historically leading to a 1% drop in long-term real GDP per capita, and federal regulation, based on a study they mentioned, supposedly slashed U.S. economic growth by 2 full percentage points since 1949, making the economy today, in their estimation, 28% smaller.
Wow, that's a huge claim about regulation. Really shows their perspective on intervention. This then leads into their discussion about the West outsourcing manufacturing, mainly to China. The newsletter argues this created a split society, a wealthy elite and everyone else left behind. And this growth model, they say it's increasingly fueled not by productivity, but by selling off capital and piling on debt, basically consuming the seed corn instead of investing.
Right, and that brings us to Europe's green gospel experiment, which the Macro Butler holds up as a kind of cautionary tale. Europe bet big on what the newsletter calls overpriced, low transformity renewables and the economic impact. They note Jamie Dimon's observation that Europe's economy shrank from 90% of the U.S. size down to just 65%.
And you see it hitting industry hard. The newsletter talks about Europe's petrochemical industry basically crumbling, plants shutting down because energy costs are just too high. Big names you know, Ineos, Eni, Dow, Exxon, Total, Shell. They're closing up shop or looking for the exit. It's gotten to the point where the UK extended its main renewable subsidy scheme, Contracts for Difference, to 20 years. And the government gets to see the bids before setting the budget, basically ensuring they get the capacity built regardless of cost.
The newsletter's argument here is that Europe is essentially ignoring physics. They claim real market price discovery would reveal the brutal truth that renewables, with their low transformity, might work for a medieval economy, but they're disastrous for an industrial one. They mention German industry beginning to panic over energy costs. And then there was that blackout in Spain and Portugal back in April 2025, apparently. Left 50 million people dark. The cause. Power oscillations from relying too much on weather-dependent sources, only 15% came from stable generation at the time. A stark warning, really.
It really is. It makes you think about what a modern grid actually needs, doesn't it? As the newsletter bluntly says, you can't run a modern economy on vibes and solar panels. And even with record solar and wind additions in 2024, China doing the heavy lifting, they say these sources are still only about 15% of global power generation. That's not a huge share given the push.
And looking forward, this whole energy question gets even more intense when you factor in AI. The energy demands are just mind-boggling. OpenAI apparently signing up for 4.5 gigawatts, Meta planning hundreds of billions for these massive AI data centers, Prometheus and Hyperion, each guzzling power like mini Manhattan, as the newsletter puts it. Just for context, 1 gigawatt powers around 750,000 homes. So, yeah, huge numbers.
And grids are already feeling the strain. We're looking at potential 20% spikes in electricity bills this summer in the PJM interconnection area, a big data center hub. You even have companies like Blackstone apparently building gas plants right next to data centers now. The newsletter's point is that fossil fuels, even though they're shunned by policy, are still doing all the work. They point to China continuing to build huge coal-to-chemical plants, 12 mega projects, $70 billion, adding 4.5% to global coal use.
So the big question the newsletter asks is, where does the energy for AI actually come from? They contrast Western green dreams, as they call them, with emerging markets firing up coal and natural gas for growth. Global coal production hit a record in 2024, 9 billion metric tons, mostly China and India. India is set to burn twice as much coal as the U.S. and Europe combined by 2026. Coal is still 35% of the world's power mix, and they expect it to stick around for 30-plus years.
But amidst all this, the newsletter sees real hope in nuclear, both fission and fusion. They talk about China's thorium-based nuclear revolution in the Gobi Desert, a molten salt reactor using thorium, refuels without shutting down. They apparently plan a version 10 times bigger by 2030, with enough thorium reserves for 20,000 years. And then you have Sam Altman's Helion Energy promising a fusion power plant by 2028. Still speculative, but exciting.
But the immediate challenge for AI, according to the newsletter, is whether it can generate enough value to justify its energy use, or if it just gobbles up capital. They even raise the idea of diminishing returns. Throwing more compute power at AI might yield less extra intelligence, but consume way more energy. So from their perspective, the AI race might just run out of energy before it gets where it wants to go.
Okay, so all of this has very direct, very real implications for you as an investor. The newsletter stresses how energy prices hit currency and stock markets. They show an inverse link between European natural gas prices and the Euro USD, for instance. Higher energy costs don't boost your currency. And, well, it seems obvious, but they emphasize higher energy costs erode corporate profits and hurt stock performance.
Which, they argue, gives U.S. equities a structural advantage right now. Why? Cheaper, more abundant energy, and in their words, less adherence to green delusions compared to Europe. This difference, they say, is widening the valuation gap favoring U.S. stocks. And speaking of investments, they have a pretty cynical view of Wall Street's ESG push. They basically say it's about profit, not polar bears. They contrast the MSCI Energy Index, profit churning they call it, with the S&P Global Clean Energy Index, which churns tears. Ouch.
Yeah, quite pointed. And this tough economic backdrop, they believe, is signaling an inflationary bust. They point to a specific technical signal. The S&P 500 to gold ratio falling below its 7-year moving average for over 6 months. For them, that's a sign the bust is actually starting to materialize, maybe faster than people think.
So, what's the playbook for investors in this chaos cycle, as they call it? This period of instability, energy volatility, rethinking economic fundamentals. The main principle they suggest is focusing on investments that genuinely reduce energy costs and improve access to affordable, high-quality power. It's not about feeling good, it's about backing things that foster real resilience and sustainable growth.
Right. And their advice gets very specific here. They see the business cycle shifting. The outperformance of IT, big energy consumers, they expect that to fade. Energy producers, they see them making a comeback. The advice is blunt. Buy the dips in energy producers and sell the rips in energy consumers. For stocks, that means tilting towards energy. Integrated majors, E&Ps, oil field services, uranium miners, they admit these have underperformed, but they foresee a potential great rotation into the sector.
And for the cash portion of a portfolio, they recommend short-dated USD investment-grade bonds and T-bills. Keep it safe, keep it liquid.
Right.
They are very emphatic that long-dated U.S. Treasuries and bonds are an uninvestable, returnless asset class right now.
Okay, so beyond energy, they suggest looking for lean, low-debt, high cash flow champions, companies ready for reshoring, trade tensions, maybe rising defense budgets, and then gold and silver.
Yes, they express incredibly strong conviction here. Physical gold and silver are positioned as the only reliable hedges against reckless and untrustworthy governments and bankers. They call them ultimate anti-fragile shields. No counterparty risk, hard to confiscate, real autonomy from fiat money, and a hedge against, quote, collective stupidity. A stark contrast to digital assets in their view. Overall, they tell investors to brace for much higher volatility as well as dull inflation-adjusted returns. They expect the Dow to beat bonds, energy producers to outperform energy consumers, and gold to keep stealing the show.
So let's wrap up this deep dive into From Watts to Wealth. The core message from the Macro Butler is powerful. Energy, specifically its quality and density, is the bedrock. It drives prosperity, wealth, freedom, impacting everything from GDP right down to your investment portfolio. It really challenges conventional thinking.
Yeah, and if you think about the broader implication, the newsletter suggests the future belongs to what lasts. They even connect it to Andrew Carnegie's philosophy. You are what you think, so think big, and so on. For the Macro Butler, thinking big means aligning with these fundamental truths about energy and physics. It's not just about assets, but a mindset trusting in freedom and prosperity for all. That's the core of their Golden Lots survival playbook, as they term it.
It's definitely a lot to chew on. We hope this gives you, our listeners, some real food for thought. Consider these ideas about energy density, how they shape society, and how understanding them might help you make better informed, wiser decisions. Thanks for joining us on The Deep Dive.